Lithium is suddenly at the center of a global energy shift, shaping the future of electric transport, grids, and consumer electronics. Today, price moves, policy incentives, and new mines collide in a way that could redefine supply chains for years. Investors watch battery metals because every EV announces another mine, another contract, another volley of bets on who controls critical capacity. From Chile to Australia, from miners to automakers, the lithium story touches miners, traders, engineers, and pension funds. The topic matters because lithium profitability, reliability, and access determine who wins the next generation of energy tech across the globe. At its core, lithium is a light, highly reactive metal that powers lithium-ion batteries. In practice, supply comes from two main routes: brine routes in salt flats and hard rock mining in granite or pegmatite deposits. Brine operations exploit sun and water chemistry to extract lithium dissolved in brine pools, then concentrate it into usable compounds. Hard rock mining relies on open pits and refined processing to isolate lithium carbonate. Demand today outpaces early forecasts thanks to electric vehicles, energy storage, and consumer devices. Prices respond to mine approvals, front-end capex, processing breakthroughs, and the sinews of global trade and policy. The lithium story began long before electric cars, with early uses in ceramics and metallurgy. Commercial exploitation began in the mid-20th century, but it was only after bright green policies and battery chemistry breakthroughs that lithium rose to strategic status. Chile led buffered brine production for decades, while Australia emerged as a modern hard rock giant, followed by Argentina and China. Price cycles have bounced between scarcity scares and technological fixes, yet the underlying demand ramp has persisted. Environmental concerns, water rights, and indigenous consultation shaped permits, cost curves, and the pace of expansion across continents over the decades. Today, the market treats lithium as a barometer for the electric era. Spot and term prices swung with policy signals, mine approvals, and project timelines, even as long-term demand remains defined by vehicle sales forecasts. Investors chase ETF baskets, derivatives, and equity stakes in miners and producers, while processors lock in supply through offtake agreements. Battery manufacturers and automakers renegotiate pricing with suppliers amid capex cycles and rate changes. Shipping and logistics bottlenecks multiply costs, while currency volatility adds a second layer of risk. The market response blends optimism about growth with caution over execution and environmental costs and governance. Automakers, battery producers, miners, and long-only funds all feel the ripple effects. Car brands need predictable supply and price discipline to plan models and pricing, while battery manufacturers manage margins against charge cycles and inverter costs. Miners invest billions to expand capacity, courting banks and sovereigns for project finance. Suppliers across chemical processing, electrode production, and testing services gain or lose as procurement shifts occur. Hedge funds and pension funds balance risk with growth, retail traders seek exposure through ETFs, while policymakers weigh incentives, trade routes, and environmental standards that shape profitability. Regional markets diverge on permitting speed metrics. Geopolitics shape lithium almost as much as chemistry. The cluster of production in Chile, Argentina, and China, with Australia as a major export hub, concentrates risk and leverage. Water rights, indigenous communities, and environmental reviews constrain timelines, while neighboring countries debate royalties and nationalization. At the macro level, inflation, currency swings, and policy incentives, European Green Deals, US IRA thresholds, and China's buffer policies drive investment cadence. Infrastructure bottlenecks, port congestion, and energy costs compound unit prices. The result is a climate in which policy signals can swing the costs and feasibility of multi-year mine expansions, and regional diplomacy remains unsettled. Smart money is leaning into the long term, even amid volatility. Institutional buyers favor diversified exposure through ETFs, mandatory funds, and cross-asset mandates that blend growth with risk controls. Corporate strategies show longer-term offtake agreements and vertical integration bets, with manufacturers securing supply through joint ventures, tolling, or equity stakes. Banks and sovereign wealth funds finance capex for new mines, refinery upgrades, and battery plants, chasing inflation hedges and decarbonization goals. Retail flows concentrate as traders hunt momentum, yet risk managers push position limits and stress tests. In every action, liquidity and transparency determine how fast lithium bets mature. Bear case risks remind investors to temper enthusiasm with caution. New supply could arrive faster than expected, eroding leverage and creating a glut. Substitution could reduce lithium intensity in batteries if alternative chemistries advance, or if sodium-ion chemistry proves viable at scale. Political backlash over water use, indigenous rights, or environmental costs could stall projects and raise costs. A sudden easing of EV demand or a global recession would depress prices and capex. Geopolitical tensions, shipping bottlenecks, or tariff shocks can undermine long-term contracts and put pressure on margins for miners and downstream players across the supply chain. Retail investors can respond by building a disciplined plan rather than chasing hype. Consider diversified exposure to lithium through broad commodity funds or diversified miners instead of one name. Set clear risk limits, use stop losses, and rebalance as prices swing. Track long-term demand scenarios tied to EV adoption and grid storage, not day-to-day volatility. Focus on companies with transparent offtake agreements, environmental management programs, and robust cash flows. Use education, not speculation, to judge trimming, adding, or exiting. Maintain liquidity, avoid excessive leverage, and stay aware of policy shifts that alter profitability in different market cycles. Looking ahead, lithium remains central to the energy transition, but timing and term structures will shape returns. Long-term demand appears solid as automakers digitize fleets and storage needs rise, but the pace of supply responses will determine pricing discipline. If new mines and processing capacity unlock, prices may normalize, enabling broader participation but reducing upside leverage for speculative bets. If bottlenecks persist, prices could remain elevated and volatile, forcing policymakers to adjust incentives. For retail investors, patience and diversification beat speculation. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.